In today's video, I'm going to walk you through a CTS trade and at the very end, share with you two important lessons about risk management. Yep, we've got divergence. We got a longer term divergence as well. So if we look at our previous high right here, and we look at our most recent high right here, which I already had a circle around. I don't know why I need to draw it in. Anyway, habit, right? We can see the market is making higher highs, obviously. However, on our indicator down here, we are making lower highs. So we got some longer term divergence there as well. So we have a double top, right? If we're thinking about this as a CTS trade, right? We're adding up. If you guys are brand new, the CTS is the combined technical scoring system. It is basically a way to quantify our trading. So imagine like we have a big checklist of requirements here. Each of these requirements have a specific point score. And all we're doing is we're going down the list, we're adding up the point score, and the point score tells us whether we should take the trade, whether we should not take the trade, whether we should take it with full position, half position, what have you, right? So we have a few things here. We've got structure, bang. We've got double top, bang. We've got RSI overbought, bang. We've got RSI divergence, bang. We've got even handled number. If that's in your CTS, again, it's customizable, so you can add it if you want, bang. We've got Fibonacci, bang. You're adding your point score and you should get a pretty decent point score out of this. So this was a solid one for me. Again, I got involved in it this morning. I'm currently 1 pip in profit. Woohoo! I'm at 90.10. 90.10 and some mini pips. That's where I got involved. So I'm like 1 pip in profit. Woohoo! Right? I've outbeat the spread. But a nice trading opportunity. Stops as always need to go above, or should, in my opinion, go above our highs here, right? So if you're entering at market right now, right around here, stop should be above the highs. Mine's at about 91.60. Targets, a couple things we can look at. For me, it was a retest of our previous structure right here. Again, I'm a very conservative target taker. Sorry, that line got rogue. I'll get to the questions on YouTube in a little bit. But I'm a very conservative target taker. So previous structure highs right here were my initial target. If you're someone that is a little bit more risky and you have, let's say, a larger outlook, what are a few more areas? I want you guys to kind of help me out here because I think that's the best way to learn. What are some other areas that you might use to or that you might enjoy or fancy taking targets at, whether it's a more aggressive first target, maybe it's a secondary target. Anyone have any ideas here? So I've got to upload the recording for the live room, so I'm probably going to be unable to update you guys for the next hour or so, but I wanted to pop in real quick with our Aussie Canada trade from this morning, just kind of tell you what I'm looking for. We're approaching the valley here of our double bottom. This is it's on the 4 hour, but I'm watching it on the 60 for trade management purposes. If we can violate that level, that will be a very positive sign that we're likely to continue lower down to my initial targets here. That's also going to give me the ability to manage my stop loss, right? If you guys are on the platform, we did a really good Q&A session on Monday about risk management that I highly recommend watching, but it spoke about how risk management is the key to really that second level of success in trading. Typically as traders, right, we're going to improve a little bit with our execution, with our filters, with our recognition of the market, but our strategy tends to be what it is. It doesn't really change all too much. So how we can change things is by managing risk. We can either get better with target taking and projecting those levels, or get better with risk management, meaning picking better stops or just managing and reducing that risk as soon as possible while kind of giving the market room to breathe. So if we can violate those levels, that's going to allow me to manage my risk, taking a lot of it off the table, which will be good if this thing happens to reverse. But I'll keep you guys updated after I record or after I upload today's live room session. All right, gang, back for a brief update. You can see price action rolled down. We did break and close below that valley I spoke about earlier. We came within pips of hitting target 1, but started to retrace. So not going to take my targets out. I don't have a rule about kind of taking it out just because it's right there. I'm going to give the trade a chance to play out, but I did reduce risk. You can see that initial risk is now down to break even. So worst case scenario, even if this thing does come back to stop me out, I'll be taken out for break even or just lose a little bit of a spread on it. So again, this is what we spoke about on Monday's Q&A, right? Risk management, putting us in the position where when trades are going in our favor, we are either reducing risk and or locking in profit. Again, number one rule of trading is don't go broke. We want to conserve capital. So whenever we can get a chance to put ourselves in a position like this, it is a positive win, lose, or draw. Or I guess not lose, win or draw. All right, guys, so disappointing trade. You can see that price came about 1 pip before targets, never came back for a secondary chance and a chance for me to exit on my close enough rule before moving up to being stopped out for break even. Now, there are 2 good lessons here. One, the importance of risk management. Again, we've been talking about this since the weekend video. We did a Q&A on this on Monday. This is the advantage of using a risk management tactic, right? Instead of being taken out for a loss, which I guess technically it wouldn't have ran up for a loss yet, but if this thing were to run up and continue higher, right, I would have taken a loss, right? A loss about the same risk as my potential reward. Instead, I got out for break even, so it ends up being a scratch trade. Now, I know what many of you guys are saying. Well, Akil, price came so close to your targets. Why didn't you just cash out? And we're never going to win the debate whether that is a wrong or a right thing. That's going to be up to you and your personality or your personal decision making. I can tell you this, it's always easier in hindsight when something misses to say I should have gotten out. It's always easier in hindsight when something rolls further than your projected targets to say I should have stayed in. The coulda, shoulda, woulda trader, the hindsight trader, is never consistently profitable. But following up on our conversation, I'm not sure if you guys heard it or not, depending on how I edit this thing, about no single trade matters. Remember that our edge, our statistical probabilities that are in our favor, they're worked out over a handful of trades. I'm talking hundreds, I'm talking thousands of trades, right? So no individual trade makes a massive difference, right? No win here or no loss tomorrow is going to make really any difference in the outlook for the end of my trading year. However, the biggest thing that I fear, and I fear it because I've been here before, right, is cracks in trading psychology. Now, trading psychology, those are different mistakes. In this case, early profit taking. I've seen this before. Let's say I take profits early on this individual trade. Doesn't really hurt too much. I look at it and I say, man, glad I did that. I made 60 pips or whatever I made on it. Right decision. But what happens the next time a trade goes in my favor? Well, because it was the smart decision to take it out early the last time, it's probably the smarter decision to take it out earlier again. So I take it out, instead of 1 pip early, I take it out 5 pips early. Then I do it again the next time and I take it out 10 pips early, then 20 pips early. And before you know it, I'm cutting my potential reward in half. And how do I notice so thoroughly? Because my best friend, the guy that introduced me into Forex trading, he did this. He started taking profits a little bit early, and before you know it, it snowballed until he was taking profits basically halfway to where his profits should be. Many of you guys are saying, well, I still don't see the problem with that. You can't go broke taking profits. Well, you can. If your profits aren't making up for your losses, which you are still taking full losses, now your expectancy is all messed up. Your wins aren't making up for your losses. You have a good win rate, but you still find yourself in a negative. And for a very long time in my trading career, I was a high percentage trader. I'm talking 70% win rate, but I was break even if lucky. Usually I was losing money. So hopefully this is a lesson to you newer traders out there. I know it hurts to see it. It shouldn't hurt. It's not your money. It's my money. It should hurt me even more. But to kind of turn a bad situation to a good lesson, this is a good lesson on discipline. This is a good lesson on being emotionalist when it comes to trading, and understanding that the number one thing we should be doing is following our plan. Sometimes it's going to hurt, yes, but bigger picture, it's going to reward us and help us much more than it harms us.